This is Omar Khan. I'm the founder of Boardwalk Wealth, and this is our summer end 2023 State of the Union video. So before we get into the meat and potatoes, here's a teaser. A couple of concepts I want you to think about. Number one, there's a time and place for everything, and right now is not the right time for aggressive value-add acquisitions. And number two, survive till 25. Don't worry, we're going to go into a lot of depth about this. Keep listening. But first, I'm going to introduce our Chief of Staff, Eric Wong, and I'll give him the floor.
Thanks, Omar. What's going on, everyone? I'm Eric Wong. I'm the Chief of Staff, and I'm also the Head of Investor Operations. So we've got a lot to cover again today, so let's give a quick overview of the topics. We're going to talk about the hot topic today in the news and everywhere, which is macroeconomic trends. And then we're going to transition into risk management and potentially our shift in focus. And then we're going to talk about acquisitions, which Omar just mentioned. We'll then transition into our portfolio, an overview of what's going on with it. And then we'll talk about our love of Sioux Falls and our developments in there. And then we'll get into our cash flow fund, which, by the way, is unrelated to real estate. And then we're going to end off just going over some upcoming deals and potentially some event previews. So, Omar, before we dive in, I know why people should listen to you. Our investors know why, but maybe you should tell people who are uninitiated, why should they listen to you and what you have to say?
Well, simply put, I have the experience professionally and academically. So I'm going to start academically. I'm a CFA charter holder, which is a gold standard in portfolio management. That gives you an idea about my academic background for what it's worth. But professionally, we've transacted on over $450 million in real estate transactions, and separately, $3.7 billion plus in capital financing and M&A transactions. So suffice it to say, I've got a very holistic experience across the board. And most importantly, no multifamily capital calls, no foreclosures, none of that stuff.
Okay, thank you, Will. With that impressive background, we're going to get started. All right, so the first section we're going to talk about is macroeconomic trends. So this is a big topic here and a major topic of discussion.
The biggest topic.
Yeah, exactly. So the Fed's rate hikes. So they did a bit of a pause and then they hiked again. Omar, tell us, what does this indicate to you?
Well, the short answer is it depends. And I'm not trying to skirt the answer. I'm not trying to be cute. The simple fact of the matter is the Fed, we've never really had a series of events where the Fed has paused, raised rates, paused, and potentially with the upcoming meeting and coming up, they might raise rates again. That's what that's what they're guiding towards, or messaging is along those lines. And we've never really had those sequence events, because typically what's happened is that the Feds raise, then they pause, and then they cut. And that's been their book for the past couple of cycles that they've raised and dropped rates at. Now, this is a very different cycle. Some of this is of their own making. Basically, they were too late to the party, and then they became very aggressive. And some of this is just the zero interest rate phenomena just taking over, and bad things happen then. You keep interest rates at zero. So the short answer is it depends, because there's lots of factors. And right now, weirdly, good news, which is, people getting jobs, the economy booming, is actually bad news for a lot of real estate people. Typically, it's good news, people getting jobs. It's bad news now because the Fed will look at this data and say, we've got to aggressively raise rates again. So good news is bad news. Weird as it sounds. It's an upside down world. The other deal also is the Fed has resolutely committed to staying at the 2% inflation mark. There were some questions on whether they'll give up that target or just not talk about it anymore. They have doubled down on that. They've said they're continuing to be data dependent. There is increasing coordination with other big central banks around the world. But basically, we're in uncharted territory. And the sequence of events that I was mentioning, raise rates, pause, raise rates, pause, that's unprecedented. The market is timing, or rather factoring in, a couple of rate cuts, significant rate cuts actually in the next 6 to 12 months. Personally, I'm not really buying that. Not material rate cuts. There might be one or two. And the reason is very simple. Any of this hard-won credibility that the Fed won after the inflation is transitory debacle, they are going to lose all of this credibility if they just jacked up rates and then they immediately start cutting rates. So I believe, if anything, there might be modest rate cuts, maybe one or two here and there in 2024. That's how we positioned our portfolio. That's, by the way, how we are generally, right? We're very conservative and we're always very paranoid about things going awry. But I think the market is very optimistic. They're reading too much into the Fed's words, and they might be in for a surprise.
Okay, so with all that said, the eternal question is, cash, is it king or is it trash?
Well, look, I always laughed at this when people said cash is trash, because look, cash, you only really find out the value of cash in uncertain times. Cash, or having a good liquidity buffer, allows you to opportunistically act when other people won't act. So cash is king. It has remained king. It will be king forever, because it affords it affords just people who have cash, right, who have liquidity, to step in at times of extreme distress, buy assets at discount, and that's how you make generational wealth. Look, great examples of this are Warren Buffett in the 2008 crisis. This guy's lending money to Goldman Sachs, AIG. I mean, you name it, a veritable murderer's row of like big financially sophisticated investors is what Warren Buffett is lending money to. Why? Got a ton of cash. And fortunes are won and lost during turbulent times, right? Because during the boom times, every idiot can make money. But what happens when things go awry? So cash is going to be king. But the medicine has to follow, it has to be for the right diagnosis. Because I always say it's this. If somebody says, it's always this or it's always that, they're not providing you the right answer. And as a trustworthy fiduciary, we take our responsibility very seriously. Bottom line is, there is fear and uncertainty in the market that is leading to defensive posturing. Those defensive posturings are going to lead to an increasing premium paid for cash, i.e. cash is king. But the investment cycle typically works contrary to our internal fear cycle. So whenever there is the highest form or feeling of uncertainty, where you need the cash the most, that's the time you have to double down and invest even more aggressively, because typically recession vintage acquisitions, recession vintage purchases, those are the ones that outperform.
Okay, so from that, let's talk about some economic or investing news. We were talking the other day, and you told me about some high-risk schemes that you've been hearing about, and it's increasing in frequency. Do you want to elaborate on this for our audience?
Yeah, and look, whatever I'm going to say, I say this with a heavy heart, because I know some people that are affected by this. So please don't think of this as gloating. This is just a statement of facts. So, number one, it's always helpful for us to keep our eyes to the ground, ears to the ground, eyes on the market, and just keep looking for opportunities, right? But it's very instructive for me to also see how otherwise seemingly intelligent, successful people, as soon as things go sideways, they start waffling and compromising on standards. So there are real opportunities out there right now, and as we'll discuss in this video, but there are also con men. There's lots of con men, either con men or straight up the blind leading the blind type situations. And they are taking this as an opportunity to basically bilk investors out of money. Look, we've heard a lot about carbon credit units. There's actually a federal lawsuit now against one or two of those operators. Bitcoin crypto scams that are dime a dozen, debt validation funds that are dime a dozen. I've heard of one or two ATM funds that are in trouble as well, and other exotic investments. And by the way, even till a year or 2 years ago, these were being billed as the safest investment. And the problem becomes, when there is no physical asset, it is very hard for investors to have any recourse, because if you give your money and it disappears into the ether, then when you want to recover that money, or you want to recover a portion of that money, there's nothing there. So please remember, it's always, always, always pays to be conservative. It pays to work with conservative people. Anyone that shows up in a shiny suit doing flashy things, it might work for a little while, but in the long run, it's 100% chance of you losing your money.
Okay, so that's a really good segue into our next section. All right, so our next section, we're going to talk about risk management. So Omar, is it fair to sum up our Boardwalk Wealth's past operations as a focus on risk mitigation? Is that still our focus?
Look, it's a fair way to put it. It has always been our focus. It has, in fact, been the underlying principle upon how we operate. But I want to be very careful when I say this, that, just saying, we have a business plan on forced value add and forced appreciation, which was a standard boilerplate during the boom years. That's just not the right way to approach these things, right? From day one, even during boom times, by the way, we kept saying, look, it's better to be safe. It's better to be consistent. It is better to be conservative. We've applied risk mitigation as our guiding principle. And that's why, in the spirit of transparency, and as I mentioned earlier, our mantra right now is survive till 25. Now, this comes with the added caveat that thrive from 24 and beyond, but that's not as catchy. So we're going to go to survive till 25. And I'll say this again because it's very important. It's during downturns that you really understand who you're dealing with, because this downturns or this set of downturns we're facing, as unfortunate as they are, they're nothing new. They have happened before, they will happen again. And history shows that investors, individuals who emerge victorious from these downturns are the ones who keep their emotions in check. They don't take irrational decisions. They always keep their eyes on the ball. And their whole principle is to live to fight another day. And they hold on to mantras like cash is king, as an example. So our portfolio is designed to weather the storm till 2025 and beyond, because I believe around that time is when rates materially start coming down. So as long as you continue to focus on operations, get your collections up, increase the valuation, then you're in a more accommodative environment going forward. So I'll tell you what not to do, though. What not to do is not to put your hand in the sand and say, look, I received, or somebody said to me, we're going to get 20% IRR and double our money in 3 years in the past, and I need to do that. Because when you say this out, you are literally waving a flag, telling unscrupulous people that, hey, just show some high returns on paper, get this person's money, and then we can figure things out later. And I'm very sorry to say that's the actual reality of the situation, because you have the blind leading the blind. You have people who have no operational experience showing up. I mean, in fact, time and yet again, in the last 8 to 10 years, all you had to do was show up. You could show up with a bag of cash. You could just be a flashy marketer wearing a shiny suit, right? And even if you're a complete idiot on operations, the market would bail you out. And that isn't really the case anymore. Our business model has always been operations focused and opportunistic. When you have an operations focused team, you will make slightly more money in the boom times. But what you really do is have the probability of making way less losses during recession times. And that's what we really focus on here. We focus on the fundamentals. My team at Boardwalk Wealth is laser focused on continuing to focus on these fundamentals and these first principles. So you as investors have chosen to entrust us with your capital. This is the sum of your sweat, blood, and tears. We take our duties very seriously, but I always like to tell people, be very careful with who you invest with, because time in the market is more important than timing the market.
Yeah, that's a really good point. And it really goes to show that if your fundamentals are strong, then you can weather the good times, the bad times, and you're going to come out ahead. But there's just a lot of people that during the good times, they're going to do well anyways. It's like the whole stock market boom. Everybody's a genius. But then when things start going awry, then everyone's panicking. Okay, so with that said, unless market fundamentals change, the current focus is risk management over return enhancement. Does that mean that there's going to be a continued distribution pause?
Oh, yes, exactly. On certain deals, we have paused distributions. Now, why have we done that? We have done that to be prudent and to be effective stewards of your capital. And we had a lot of trepidation. I mean, the data was showing it. There was a lot of trepidation. Should we do it? Should we not? And I have to say, I'm very heartened and glad and happy for the financial literacy we have with our investors. In fact, I've received many emails. I thought I was going to get a lot of emails the other way. I've received many emails with people actually commending us for doing this, because they've said other people haven't done it. And a couple of months later, now they're in real trouble because liquidity has dried up, right? So I'm frankly very honored and very grateful for the trust people have entrusted in us, for the sophisticated people we deal with. And I've also heard from many other sponsors that when they went out with their message, they practically had a revolt on their hand. But I guess it's a case of, you get what you put in, right? We have been preaching this thing from day one. This is why, again, I keep saying this flashy person, shiny suit example, because we had never done this thing. I mean, during boom times, we kept saying, look, don't worry about don't worry about flashy stuff. Just put your head down, chart a middle path, and hope, and just do your work every day, right? Every day, just come up, do your work, take the right decisions for the investors, and long-term it will work out. And this principle, by the way, we might lose a few deals because of it, right? We just don't get into deals. Somebody pays more money or some version of that. But it helps us to protect investors' capital to the highest with the highest probability. And I'd much rather lose out on not getting a deal, not having it awarded to me, not patting myself on the back in the short term, and ensure that we're effective stewards of investors' capital in the short, long, medium, and long term. And that's the position we've always taken, and that's the position we're going to continue to take.
I also want to step in and just give an important distinction here, which is even though we're pausing distributions, that preferred return is still accruing for you. So it's most of our investors understand that, but the ones who don't, what that means is you're still going to get paid that preferred return before the sponsors take part in any sort of profit sharing. So it's mutually beneficial for us to protect your capital, but then also do well on the property so that at the end of the day, we're all going to profit. Can you just give a comment on that, Omar?
Look, that's the structure that's built in. That's why from day one, I've always said, be very careful with who you deal with. These trade profit splits, people say, oh, it's very easy, just 80-20 or 70-30 or whatever. And that's not the right thing to do, in my opinion, at least, because as an example, and I can use myself as an example, investors should not be paying me or my company to barely do the bare minimum. We have to perform at a certain level. Otherwise, you should give your money to somebody else. That's just the reality of the situation. Therefore, it is better to have structures with a preferred return, with the catch-ups, all of this for investors, so that they are protected in case bad events happen. Because now we have to overperform in the future and take a cut out of our own profits to ensure that we protect our investors.
Okay, Neil, thank you for the clarification there. So let's move on to our next section. So in this section, we're going to talk about acquisitions. I've gotten a lot of emails. So if people are asking, hey, are you doing acquisitions anymore? Where are they? So Omar, tell us, what are you seeing in terms of acquisition opportunities, and why aren't we offering any acquisition deals right now?
Look, we'll continue to be in the market. We continue to make offers, but the issue is simple. There is a wide bid-ask spread, and I'm going to get into that. It's very simple. What this means is that we're not opposed to acquisitions. We are continuing to offer. It's just that the juicy deals that we want that are opportunistic, we just don't think they're there right now. And the reason is a wide bid-ask spread. So what does this mean? The bid means the price that a buyer is willing to pay. Like, so for instance, if I'm trying to buy something, what is the price I am willing to pay? What is my bid, right? And buyers by nature right now are looking into the future, and they're very pessimistic. So they are asking themselves, hey, is the price going to be lower in 2 years? And if it is lower in 2 years, either why should I even buy, or I should get a discount right now? The ask, the bid and the ask is from the seller side. The sellers, by definition, when they own things, they look at a comp from, say, a sales comp from 6 months ago, a year ago. And by definition, because they want the highest price for their asset, they say, well, things are going great. Why should I give you this at a discount? I know what I've got. And because buyers and sellers are at an impasse, it's at loggerheads. That's why you have a wide bid-ask spread. The bid is lower, the ask is higher, and therefore the twain don't meet, right? So that's why it's happening. But again, I believe clean deals in A and B markets with clear value-add and deal stories, they'll still get a ton of offers. It's just that it is harder for us to transact on acquisitions right now, not developments, purely because we don't feel we're getting a good enough discount to take any of the risk on our shoulders.
I'm going to summarize that for the people who are less financially savvy. So basically, that just means that everybody overvalues their belongings or their properties,
including ourselves, by the way. Because when we want to sell something, we want to get the highest price. But when I want to buy something, I mean, my ideal price would be $0. In fact, ideal would be somebody paying me to buy an asset off of them.
Yep. Okay, so another question that we're constantly getting, the emails, phone calls, is, hey, how are we responding to fluctuating market conditions?
Look, like I mentioned, we're always in the market. We're always bidding on assets for a couple of reasons. It allows us to keep our ears to the ground. It allows us to see who's transacting, what's the price is like. It just gives us a good pulse on the market, right? But it's just, I told you, the wide bid-ask spread is leading to less opportunities to transact on the acquisition side of the thing. And this is why, by the way, activity volumes across the industry, they're down like 60, 50, 60, 70% across the board. But ours is an opportunistic business to begin with. And patience is key. In fact, patience is the real asset one has, or we have as an example, because we're not forced to transact. Now, the issue is fast happening that people that either scaled up quickly or they have less resources, their issue is they've got a big payroll. And they have to transact. I mean, this is an open, dirty secret that people typically, bigger operators who've got big fixed costs, they have to transact. Because when they transact, they get a fee. They take that fee and they use it to pay their payroll. Because otherwise, people are going to leave and they don't have payroll. So a lot of those types of people, they're transacting, but investors are only going to find out in 2 or 3 years' time that those deals are some of the worst deals that they're ever going to invest in. We are not in that position by design. It has taken me about 6+ years to get to this position where effectively each piece was put into place for this reason. We do not want to be forced to transact ever. That has not been our business model because we did the math a long time ago. And one great opportunistic deal is worth more than 2 or 3 or sometimes even 4 mediocre deals, not even talk about deals where people lose money on. So we don't want to be in a position to transact forcefully. Lots of other players that have got big payrolls, they're forced to transact, and that's what's happening. But this is what happens in investing. If you are a good investor or you want to try to be a good investor, patience is key. You have to have the ability to sit back, wait for the fat pitch to come, right? This is not like baseball. If a pitch is coming, you don't have to hit it, right? You can wait for the fat pitch to come. Then when the fat and juicy pitch comes, that's when you double down aggressively and go for the kill. So I believe the operational issues are ongoing as most sponsors, even the big ones, are horrible at operations. They literally are. I mean, this is an open secret. They're purely marketing machines, and their whole purpose is to raise the maximum amount of investor capital, get the most amount of deals, take the fees, and move on. And by the way, that business model was great for 8 or 10 years. It's not so great right now, and a lot of these people are in trouble.
Yeah, and just to piggyback off of that, the proof is in the pudding. Whenever our investors email us and say, "Hey, where's our P&L? Where's the balance sheet?" You're the first guy to send it to them because you're so hands-on in everything. So it's not just saying something, but you're actually doing it.
Well, I mean, like I said, talk is cheap and actions speak louder than words.
Absolutely. So let's talk about our target market. So you always talk about us playing in our sandbox. Do you see any distressed opportunities in our sandbox?
Oh, there is a lot more distress coming. Right now, most of the distress that we're seeing, at least, and we're talking averages here, right? Not specific opportunities. Most of the distress we're seeing right now in acquisitions, again, I just want to point out value-add acquisitions, right? They're C deals and C markets. And the problem is only God himself can come save those deals because frankly, I don't think humans have the ability to save those deals. But I think next year, going into Q2, Q3 of next year, maybe Q4 of this year, Q1 of next year, but most likely Q2 to Q3 of next year, we're going to start seeing a lot of Class A and D distress happening. This is mostly due to capital stack issues, which means there is a debt issue. It's not an operational issue typically here. So we are going to continue to pursue these deals. Look, we continue to pursue deals all the time. It's just that enough juice isn't there basically. So we just need to find a seller with a realistic price expectation. And if it doesn't make sense, like I mentioned, we don't have a clear runway ahead of us. We don't see a clear financial picture. We're not forced to transact. We're in a very comfortable position and we want to stay in a comfortable position.
Yeah, I remember you sending me basically as a rite of passage into some C deals just to show me what the comparison is. So can you just confirm that we are still looking at A and B and that's our focus for acquisitions?
Guys, we have always looked at A and B deals. And the way I look at A and B deals is I look at demographics. I don't just look at the age of the property. I know people get really hung up on stuff. I've always looked at demographics because, as an example, I'd much rather own, say, something on Fifth Avenue, New York, which is, say, 80 years old, than to own something in a dying one industry town that was built like 2 years ago. Right? It's just demographics. That's just the reality of the situation. Buildings don't pay us money. In people living in them pay us money. They pay their rent. So we always look at demographics. Now we also look at the age of the building because we have to make our entire plan. But the way I define A, B, and C is the demographic class that we're attracting.
Okay, thank you for the clarification. So let's move on to our next section. In this section, we're going to do a portfolio overview. So while we were just talking about acquisitions, can you please take us through the Boardwalk Wealth acquisition portfolio and tell us what are some of the current struggles that we have and how are we overcoming them?
So I'm going to read some stuff off the screen because our team, shout out to Miles Gray, our operations director, for compiling all of this information for us. So right now, our portfolio occupancy is approximately shade over 95% across our portfolio. This is an occupancy. This is 0.4% increase compared to the end of Q2 2023. The average in-place rents are $1,337. This is $8 higher than the end of Q2, and the market rent is our average across the portfolio, $1,437, which is about $33 higher than the end of Q2. So you can see both the average rents are increasing as well as the market rents are increasing. And by the way, we have across the portfolio at least $100 of loss to lease opportunity, which we're continuing to burn. So now we are continuing to selectively upgrade the units across the portfolio. Like I mentioned, it's all because of the loss to lease opportunity. But what we've basically done is we've modified our renovation scope. We do this regularly, but we've done this even more this year. We are able to shave off anywhere from 5, 15, all the way up to 25% of the cost by just changing the scope of the renovation. Again, it's done on a property by property level, but the operational challenge, if any, is to take our current performance and compare it to, say, the glory days of 2021, maybe 2022. But in my mind, that's an unfair comparison to make, even though I make it with my team, because rents rose in double digits. And that's an anomaly. That's not reality. Nothing can rise double digits forever. So for us, the biggest challenge is reaching up to our high water mark that we have achieved in earlier situations, and it's mostly a growth issue. Now, the biggest struggles for us, it's less of an us issue, it's more of a counterparty issue, is capital markets. Essentially, where are the interest rates? How much are they? How hard is it to get a loan? And not because for our portfolio, because while our portfolio is not as heavily affected by this, we still want to transact. We might want to sell an asset or 2 or 3 or 4 or 5. In fact, you want to give me a good price, I'm going to sell you the entire portfolio, right? But as I mentioned, I lamented about the bid-ask spread. We sometimes want to transact and sell assets. Now, we need a ready counterparty for that. So if our counterparty is having issues, they're maybe not as well capitalized as us. If they're having issues going to the debt markets, getting debt, then their probability of what we feel is overpaying for our asset significantly reduces. So that's a challenge that we have to manage on our end. Our properties are not as much affected, but if we want to sell these properties, going into a restrictive lending environment in the market makes it harder for us to transact at the prices and the values we feel are an appropriate valuation for our asset. But our business plan has always been, I keep saying this, it feels my team tells me I'm beating a dead horse all the time, is always risk management. It boils down to this. We continue to perform. We're going to continue to exceed our pro forma. Our focus is just doing our job, putting our head down, getting into a busy 2024. Hopefully, it's a more accommodative environment. It's an election year. Hopefully, it is. And then, and the whole point here is, guys, if you do the right things, you take the right steps, you don't cut corners, long term, you are rewarded by this. And by the way, I'm not saying this. This is all the investing heroes, all the financial people you ever read about. This is all they write about. It's times of distress that you really find out what type of people you're dealing with. And sometimes you don't want to hear the answer, but somebody who's honestly giving you the answer is a lot better than somebody who sugarcoats reality and you don't really know where things are.
Okay, so there's a lot of distress out there. There's a lot of uncertainty in the market, the economy and all that stuff. But what we like to focus on are some wins and what are we doing well. So why don't we talk about some big wins, continued wins? What are some wins in our processes and what are you seeing on the ground on specific properties, Omar?
Well, the wins are mostly centered around two factors: people and culture, and then process. So we've implemented this big sister, big brother type situation here, where we've taken our selective property managers, the ones that are the superstars in our team, and what we do is we compensate them more, we elevate them, and we have them buddy up with new property managers, leasing agents that we bring on. They get these people onto our systems, they onboard them, they teach them how to run the systems the exact way we want. We're a very data-driven organization. We want data at our fingertips, and we want it right now. So our superstar property managers like Amanda and Brandy, they get people going. And what we do is we elevate the proposition of these portfolio managers. We compensate them more. We take their feedback into consideration also, because at each step of the way, what we want to do is when a new person joins our organization, we want the onboarding process to become better and better. And it's an ever evolving process, right? You can never be 100% at it. So all we want to do is every day take steps that if a new person joins us, say 1 year from now, they're just onboarding. Their experience is much better than if somebody joined us today. And 2 years from now, and 3 and 4 years from now. But what I have to do and what Eric has to do is we have to chart a path for people. We have to show them a path, both of progress, increasing duties and responsibilities, increased compensation, because the winners that we have on our team, we want them to stay with us, and we're going to do everything possible to make sure that that happens. And lastly, from a process point of view, we have started implementing, really getting into the weeds of implementing EOS within our team. Now, luckily for us, we have lots of anal people like Eric and Miles.
Right here.
That were perfect EOS candidates to begin with. We're very organized. So that process is a little better, but I do feel it's a 12 to 18 month process because which is going to yield significant positive benefits to our organization.
Oh, I love EOS because it's basically, it matches the way that I operate, and coming from a risk mitigation background of mine, it's natural and second nature to me. So yeah, we're gonna.
That's why I made it a point to say your name, because I know how much you love EOS and how much you love being so anal about it.
Oh, exactly. They say 12 to 18 months to implement, but my goal is 9 months. So I think we can do it. Okay, let's move on to the next question here. So most of our multifamily acquisitions are in Georgia and Florida. Any facts, observations that you would like to make about the trends in these markets, and how does it affect and pertain to our properties?
Look, our business is all about, we have a solid foothold in our markets, and our business is all about relationships, local relationships with local people. And that's actually become the superpower over a period of time, because the deeper you go, the more relationships you have locally, you get access to better deals, better quality and caliber of people, more people know about you, more people want to transact with you. It's the same thing. If you have a good reputation, that in it of itself is a very big asset. In fact, we have transacted on deals with people that had an excellent reputation, and those deals went smoothly. And the once or twice we've dealt with people who had a very shady reputation, we just backed away from those deals, right? Very simple. So a lot of times, if you have a good reputation, you have good relationships, people actually want to give you a first look at deals. People will tell you about emerging opportunities. So for us, we want to double down on the markets we're in. We don't want to basically, just expand willy-nilly everywhere. We don't want to be in 10 markets. We want to be in 2 or 3 markets. We're very happy with that. But this also gives us a solid leg up, because these markets are some of the hottest, fastest, and in my opinion, some of the safest long-term markets for our industry.
That makes a lot of sense. So let's move into the next section. All right, in this section, we're going to talk about our developments. So it won't be a surprise to anybody that we're doing a lot of business and developments lately. So Omar, you've put a lot of content out there about the theory behind that, but I'd like to take a moment to talk about the progress and the milestones of our existing developments. There's a lot of progress. So Omar, tell everybody about the Blue on Lorraine, the Wealth Heist, and let's talk about the Blue on Lorraine grant opening recently. And actually, before we start, can you just clarify there, everybody, how you pronounce the Wealth Heist? At first, I said Wealth House. Some people say Wealthiest. When I was pronouncing it incorrectly, you kind of looked at me. You're like, dude, what's wrong with you? So clarify that for people.
First of all, I expected you to pay more attention. This is going to go in your EOS, whatever HR folder.
Penalized, yeah.
Yeah, you're going to be penalized 2 points. It's Wealth House. It's not Wealthiest. Wealth House. Look, the name basically happened is it's on Rolling Green Avenue. The project name was Rolling Green, but we didn't really want to keep the name as Rolling Green. It's got a lot of weird connotations, right? So we were thinking of a fancy name. We thought, okay, it's got to be something European. People really like European names. They think it's sophisticated, fancy. And Caleb Weld House, that's the anglicized version of his name, our partner, Caleb. His family is Dutch. And the Dutch name was Wealth House, right? Literally, I think it means a farmhouse. And we're like, oh, that sounds kind of cool. So we kind of bastardized that version and made it Wealth House, right? Kind of sounds cool, kind of sounds European. Hopefully it allows us to make more money on rents, right?
Okay, so let's not make any mistakes about that name. So let's get into the blue, get into the Wealth House, get into the event that we just threw with our partners.
Yeah, so look, let me start by actually why we're in developments. We pivoted hard to developments about 2 or 3 years ago because I was actually seeing what was happening in our markets, right? We were seeing there were many operators that were very marketing heavy. They're great on social media. They're extremely good at marketing, but they are operationally deficient. They don't even have accounting controllers on staff. They don't have an accounting, real estate, capital markets, none of that background, but they're excellent marketers, right? Cannot take that away from them. And, we kind of suck at marketing, to be honest with you. So they were entering our market. They were grossly overbidding on assets. And what was happening as a result is, the margins are actually were reducing to the point of being non-existent. And this isn't, real estate isn't necessarily, say, a biotech company or a tech company, right? Where you'll have a 1,000x return in one day. You put $1 in, you get $1 billion or something like that, right? At the end of the day, real assets, whether people like it or they don't, are valued on a stream of cash flows. What is the discounted cash flow analysis? That's the reality of the situation. All this fancy underwriting, it's just another way of saying discounted cash flow analysis. So what we were seeing is, as more and more marketing oriented, but operationally people that sucked were entering the market, they were grossly overbidding on assets. In fact, we sold one of our assets to them. So thank you for that, right? But what we're seeing is, look, margin is compressing and our business is all about margin. So talking the walk, as I told you, only gets you so far. You got to walk the walk. So in our developments, what we did is we took a little bit of time. We had to figure out what's the right market for us. So we picked Sioux Falls, South Dakota. The Midwest is a very high cash flow market. But for us, what we're doing right now, because of our local relationships, our expertise, we're going to get into that. We're building assets into a high 7s, 8% plus return on cost. Now, what does return on cost mean? It's just a fancy way of saying it's a forward cap rate. So think about it this way. When you are selling an asset, you want to sell it at the lowest possible cap rate. But when you own an asset or you're developing an asset, you want the highest possible cap rate. The reason is because when you own something, you want it to yield the most amount of money. That's why we are building into such high yielding, basically, developments that frankly value adds, even the ones that are really juicy, they just can't get to high 7s or 8s. It's just not happening. And again, due to our deep local connections, our relationships, what's also happening is the other piece of the puzzle that we've been able to put in is the lower cost of capital financed. In fact, we just signed a term sheet. We're closing on the Jefferson Reserve. We signed the loan this week. We got it at 6.79% fixed for 5 years. I know developers right now that are a couple of $1 billion in Dallas, in Atlanta. They cannot go to the bank and even get that rate. I mean, the rates they're getting are like 8, 9%. It's actually highway robbery. They can't even get leverage. I mean, we got, I think, 70, 75%. Big time developers aren't getting 55, 60%. I mean, it's getting really hard. So because we have those relationships, we're able to actually really leverage on those things. And I've heard from many investors that, they've invested in a lot of development projects all over the Southeast and the Southwest. And these projects are in a limbo. Because the big risk with developments, I guess the big risk with all projects of any kind, is execution. Because talking only gets you so far. Eventually, you have to put up and you have to execute. And the problem that I'm hearing from investors is that they've invested with developers, with people that are really good at marketing, but not really good at operations, not good at development. And those projects are in a limbo. So this is why the Blue on Lorraine, the Wealth House, Jefferson Reserve, Briarwood Reserve, Reserve Flats, these are all progressing admirably. And there's a reason for that, because I took a long time to find the right partners with the right set of skills. We're all operationally heavy people. My partner, Dustin, my partner, Caleb, these are all extremely conservative people, deep in the weeds of what they do. And that's what allows us to deliver these projects. Basically, for instance, on Blue on Lorraine, we had a launch party on August 24th. We had over 500 people show up at the launch party. We even signed like, I think 10 or so leases that night, right? This gives you an example. In fact, people are moving in today. It's the official move-in date. The Wealth, the first building is going to be delivered in November, which is, I mean, it's more late October. We're just calling it November to round it out. And the next buildings 2 and 3 are going to be delivered in the next six months after that to round it out. Finally, what's also happening is Briarwood Reserve, the work has started. Jefferson Reserve, the work is going to start very soon. But again, you can only do these activities when you have a holistic overview, right? You can't just be a developer. You have to understand the capital market side of the equation. Conversely, you also just can't be, say, somebody who really understands loans, because somebody's got to go do their development. So in the case of Blue on Lorraine, as an example, the reason why it's a much more complex project than, say, Wealth and Jefferson and Briarwood and all these other projects is because at that time, we were able to secure debt at 3.24% fixed. It's not a typo, 3.24% fixed for 5 years. So it's approximately 2 years it took us to build. We've still got 3 more years of this debt, right? So this debt is very accretive. Now, because rates are higher, our projects now are no frills and phased, which again allows us to target these higher returns, but we had to rejig and remaneuver ourselves. But that's only possible if you've got operationally strong people.
Yeah, you guys are really the perfect trio. I call you guys the three amigos because you're the finance guy. Dustin, he's got the vision and the architecture. And then, of course, Caleb, our GC, he's the guy that puts it all together with all those relationships and the building. But let me just make a distinction here. So Blue and Veldhuis, those are 2 premium Class A developments in Sioux Falls. We also have a few no-frills properties that we're actually raising on and starting construction on. And can you just give people just a reminder of the differences between these 2 models?
Yeah, look, I love big visionaries, big scope projects. Who doesn't like to see the Taj Mahal being built by themselves, where the residents will appreciate them and blah, 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 blah. It's satisfying. It transforms communities. You feel really good for yourself, about yourself, but those are our premium developments. But we always have to stay flexible, right? You always have to adjust to the vagaries of the market. And right now, in a higher interest rate environment, you need more nimble type developments. You don't want to create these monoliths of 100, 200, 300 unit apartment buildings. You want to have 12, 24, 36 plexes, something like that. Multiple buildings scattered on a site. So what's happening is you build, you lease, you build, you lease. You're able to better manage cash flows because you cash flow earlier. You're better able to manage your operations and developments with leasing activity. And most importantly, because the cash flow starts early, lenders, by the way, lenders want to lend. Just to let you know, there's this big myth out there that lenders aren't lending. That is completely untrue. Lenders want to lend. If their problem right now is in a high interest rate environment, the typical project that a sponsor brings to them just doesn't pencil. So because typical sponsors, they're not nimble. They just know it's a one-trick pony, and that's about it. So this is what's happening. We tested this with this concept with our own money with the reserve flats. We're nimble. We adjust with the times. We have our eyes and ears to the ground. And that allows us to have these no-frill properties where basically we strip out the exterior amenities, but this is in high traffic areas, so all these amenities are available close by. We blow out the interiors. These interiors are some of the nicest interiors you're going to see in apartments. And as a result, what's happening is when the resident comes into these apartments, they have a Class A++ experience. But because we've been able to strip out all of these amenities around them, we're able to reduce our development costs significantly without a corresponding significant decrease in rents.
Okay, so from that, let's talk about the takeaway, or one of the takeaways from this video is there's a time and a place for everything. Do you want to elaborate on that in terms of our focus on developments? I mean, you've talked about it, but just sum it up again.
Look, you are correct. There's a time and place for everything and every strategy. There is anybody who tells you, oh, this is the only thing or that's the only thing. They're just frankly incorrect, right? The past 8 to 10 years, as I mentioned, was great for the value add space. All you had to do was show up. In fact, all you had to do was be great at marketing and not operations, and the market would bail you out. But hardcore operators like ourselves, we're seeing all of these changes all the time, and we're always thinking to ourselves, look, how do we add more value to our investors? What kind of value proposition can we offer that's just not shiny suits and fast cars, right? That is actual long-term value. How do we create that? And this is why we pivoted heavily towards developments 2 or 3 years ago, because we were seeing where the puck was going. because we have acquisitions. We're seeing what's happening. And look, it would be very easy for me to say in Texas, Georgia, Florida, it's very easy for me to raise money for those deals because investors have heard of those markets. So it's just easy for us to market those deals. But that's not our business. Our business is basically opportunistic, and our business is to make above market returns or try to get above market returns. So I wanted to make sure we are not going into oversaturated markets. In fact, South Dakota perfectly fit the bill across the board. We've got tons of data to show that unemployment is by orders of magnitude below the national average, below supposedly superstar states like Texas, Georgia, and Florida. Median incomes are significantly higher than Texas, Georgia, Florida, and the national average. And that allows us to actually position ourselves in a market that's now coming on the institutional radar lens. In fact, 2 or 3 years ago when I started looking at this, a lot of my friends were even asking, like, why are you doing this? Why are you looking at a smaller market? It's going to be much harder to raise money because people have that idea, raise money, do projects, right? They're thinking like that. And that was the whole point. The opportunity was because other people did not know about these markets. And 2 or 3 years ago, these questions were being asked for me. Even 1 year ago, this question was being asked. And now, as you're seeing, no cash flow, basically in Georgia, Florida, Texas, whether it's capital markets, whether it's insurance, whether it's taxes, whether it's the fact that you can't evict people, zero cash flows across the board. Or if people are giving you cash flows, they're just taking money from reserves and just paying you right now. So you think you're getting a cash flow, but you're not really getting operational cash flows, right? So as a result, now with institutions looking at these markets, I field calls every month, every 2 months, tons of calls. Hey, we want to look at your portfolio. We want to see these deals. What can we do together? Because eventually, when people get drunk, they have a hangover, then they realize the folly of their ways. And developments are a capital appreciation play. They're not a cash flow play. That's the reality of the situation. Even value add deals, counter to what you might hear online, are mostly tilted towards capital appreciation. Your cash flows aren't even accounting for 50% of your returns, right? But it's good news for accredited investors because we only deal with accredited investors. You're already, as an accredited investor, typically paying the highest possible income tax. You want to position your portfolio. It has to be diversified, but a good portion of your portfolio has to be towards capital appreciation type investments because you're going to pay a lower tax. For instance, you could make $100 and the income tax would be higher than if you made $100 in capital gains. Everybody knows that. Frankly, nobody puts 2 and 2 together usually, right? The other deal also is with our developments, the way we position them is we have the ability to refinance. Distributions typically start about 22, 24 to 27 months because that's when the whole thing is done. We try to get it done earlier, but we always like to manage expectations. Refinances are anywhere, especially in the value add, no frills development model. They're anywhere from 6 to 9 months after potential, building and stabilization. And sale is a few years out. Now, the other deal also is we purposefully shied away from the pure merchant developer model. The merchant developer model is you will build for a fee and then you will sell, right? Hey, I'll build for 100 million or whatever, and I'll sell you for 110, right? Or 105, whatever that value is. The big problem with that model is you can't effectively say that it's going to take you 1.5, 2 years to build. What type of environment are you building into, right? Because for instance, if you built 2 years ago, everything seemed hunky-dory. But now if you're trying to deliver your product right now, I mean, it's going to be pretty tough, right? You're probably not going to get the amount that you penciled or you thought you were going to get. We prefer to build. We prefer to refinance. We prefer to operate. We prefer to sell, like in that order, right? With maybe operations being the first thing, right? Maybe I didn't say the order. So this model allows us to maximize the valuation across the value spectrum. And by the way, it gives us the nimbleness. So if some person shows up, they give us more money than we think this is worth, and we're, say, just at the tail end of development, we'll sell it to them. We're fiduciaries. In fact, I joke with my team, every single thing in my house is for sale, including the furniture. Give me a good price, take it away tomorrow. I don't really care, right? So even in the current climate, because we're building into high 7 to 8% return on cost, this allows us a lot of nimbleness. But what it also allows us is that if rates do come down in the next 2 years, we have the ability to refinance aggressively. And then it doesn't take a rocket scientist to figure this out. If something works at today's elevated rate, then it's definitely going to work at a lower rate.
Okay. So let's talk a bit more about why we love Sioux Falls. You alluded to it with some numbers earlier, but we were there in June. We were just there in August for the Blue opening. And let's talk about some takeaways, boots on the ground, some numbers or whatever. I was really impressed by just the growth. So I talked to a lot of locals, especially in Lyfts and Ubers, and they were just surprised by how much growth there was over the past 20, 10, 5, 3 years. And these are locals that have grown up there all their lives. And one thing that I really like is, you know me, I like going to restaurants, I like going to coffee shops. So there's a buzzing downtown there. Omar, for yourself, what stuck out to you? What sticks out? What are some fascinators?
What Eric is trying to tell you, he's a snob, basically. So
No,
he's a
no, no. I'm
big snob. Eric is a big
yeah, you
snob.
can see with the art in the back, huge
Yeah,
snob.
Eric is a big snob. And when Eric found out we're doing this, he's like, why would you do that? I live in fancy cosmopolitan Vancouver. It is beneath me to go to these states. But what happens is that the diversified economy and the continued growth rate of Sioux Falls, look, it continues to surprise us. We have data, we can share it with people. It's all publicly available, by the way, from the Federal Reserve Bank of St. Louis. And the growth is not just, say, past 5 years. It's consistent over the past 30, 40 years. Unemployment is consistently lower. Median incomes, the actual dollar amount, and the growth in the incomes are consistently higher. And the reason is very simple. You have a diversified economy. You have a high savings rate. You have an educated workforce. You have no state income tax, and a very friendly business community. So lots of people are moving on a growth rate basis. So our team's intense focus on delivering projects on time, within budget, is always heartening, right? Because we are seeing this on our other projects. And in particular, I would like to thank Dustin and Michaela, my partners, because it takes a village, right? If you don't have the right partners around you with the right level of sophistication, none of the success that we're seeing is going to be possible. So I would like to thank them a lot. But all of our projects, Blue on Lorraine, Belsize, Briarwood, Jefferson, Reserve on Flats, they're all progressing admirably. We have a pipeline of over 1,000 units up in Sioux Falls that we're going to continue to develop over the next year and a half. We're very bullish about the city and its future prospects. And again, as I mentioned, what's interesting is two or 3 years ago when I started looking at this, people were questioning me. They were questioning my sanity, frankly. And now I'm fielding so many calls. Everybody's saying, hey, let's do this, because now they're seeing actually that this whole this La La Land fantasy of, we're just going to jack up rents by like 5 million%, and then everybody's going to magically pay us. There's going to be no bad debt. And then I'm going to triple my money in 1 year thing. That thing trees don't grow to the sky. It doesn't really work. And that's why these markets are very exciting for us. We're very glad we're in Sioux Falls. And the performance of the city, the team's execution, every month, it just gets better. And I'm very grateful for that.
Yep, for sure. So we've talked about some topics about diversification of investors' portfolios. So let's move on to our last major topic of this video. All right, so in this final section, or the final major section, we're going to talk about our QSR fund. So for people looking to maximize their cash flow investments, we have a diversification play that is not tied to any underlying real estate. It's our quick service restaurant fund. We've opened Clean Eatz franchises, which covers the health convenience market, meal planning, grab and goes, catering. So Omar, tell us about our growth plans with this and just what our investors can expect.
So look, how this whole concept came into being is we were looking at a real estate venture. So we have one end is a value add, right? Or rather, one end is development, which is mostly a capital appreciation play. One end is, or the other part of that spectrum side is basically value add plays. And as I mentioned, whether people realize it or they don't, whether they want to say it or they don't, value add, the bulk of your returns are still coming from capital appreciation. So both of these lines of work, they are very capital appreciation oriented. So if you look at a spectrum, this is capital appreciation, this is income, they're all on this side. But what happens when you need monthly income? Like what happens there, right? So for us, that was the impetus for looking at these businesses, right? And we looked at a lot of businesses. This seemed, the franchise concept, the QSR concept, seemed to be the most scalable business. And also, we don't own any underlying real estate right now in these businesses, because if I just wanted to buy real estate, I would just double down on multifamily. Right. So that was the impetus for us. We're very excited. Our second location is going to open in Florida very soon. They should be up and running by November. We've hired a marketing and branding agency because, as I mentioned, we're operators. We're not the best people in marketing. We're learning, but it doesn't come naturally to us. And bringing them on was like a shot of adrenaline, basically, to our operations. Immediately, we have noticed an uptick in revenues. In fact, I'm kicking myself every single day for not bringing them on earlier because, again, operations-focused people, not marketing people. So take it for what it's worth, right? We found that our existing operations were very good. People loved them. But the issue was that enough people did not know about us. And that was something that we had to work on. That's a marketing-based endeavor. So that's why we've hired that company, leading company. We've hired another leading company for postcard printing and direct mail. And the results are, again, immediately positive. Kicking myself, we didn't do this earlier. And these partnerships are going to start becoming more effective as we both expand the QSR platform, but right now, as we're going into the busy time of the year for the QSRs, because it's a seasonal business in Florida, right? So our intention is to target 10 to 20 locations in the next 5 years. Our investors love the cash flow heavy addition to their portfolios. And a lot of times people ask me, hey, should I just do QSR? Should I just do developments? And I always tell people, look, you should have diversification in your business, right? Or your investments, because anyone who tells you, hey, just do this or just do that, they are confusing their personal interest with your personal interest. As much as I would like to take all of your money, I tell investors, I don't think it is prudent for you to do that. It is prudent for you to spread your eggs in multiple baskets, have various kinds of investments, because on the long run, that's the way to success. I mean, that's just the harsh reality. I'd love to take everyone's money, but I don't want to lie to people, right? So investors are enjoying high cash on cash, 12% cash on cash. And if you invest over $150,000, then it's 13.2% cash on cash, paid out monthly, like clockwork. And again, that's because it's an operating company. We don't own any underlying real estate.
Yeah, so they have been getting those distributions monthly, that 12% annualized paid monthly, and then again the 10% bonus shares if they invest over 150K. So Omar, why don't you talk about some of the demographic targeting that we're doing and the successes of the franchise so far?
Look, when we started out with the market research, we were seeing that there was a lot of demand for clean, healthy eating and these types of food and this type of concept for, the gym goers, the fitness enthusiasts, and also for a soccer mom, that demographic of people, because they're primarily responsible, so far at least, for providing nutrition to the family. And they have to, and there's a big shift towards healthy meals. I mean, this is a shift across the board. We're seeing people try to shift into healthier meals, even places like McDonald's, all the places in the world. And I love McDonald's, by the way, right?
Geez. Now this is where my
this is where Eric's snobbiness takes over, because I love
snobbiness,
McDonald's, and Eric is a big snob. And I don't even understand how somebody cannot like the spicy chicken biscuit. Don't even get it. But anyways, there is a big move towards healthier eating. And what we've discovered in Florida is that, plus the fact that we have a lot of seniors, a surprising amount of them, because Florida is ground zero for seniors, that come in for our grab and go meals. And they've been telling our staff that this is cheaper than them buying groceries. They don't want to handle the hassle of cooking and cleaning and all of that stuff. So that was actually based on the information we were getting in our advertising. We've now started pushing for more of this demographic. And in fact, our latest location is right across the street, I believe, from an upscale senior living facility. So hopefully this trend continues. Clean Eatz has 5 income streams, one of which is catering. So we are ramping that up in location 1 right now. That takes a little bit of time. But this is more than a business-to-business play, right? It's very flexible. It allows you to pursue different types of businesses, people, events, and that's what makes it very exciting for us. But again, we're operations focused. We get this feedback. Now we've added the marketing company, so that will help us, basically.
Okay, so if investors, people, if they're interested in learning more about the fund and if they want to participate, what should they do next?
Well, we are going to put this in the show notes. You can visit our website, boardwalkwealth.com/cash-flow-fund. Just type that in. We're going to put the link in the show notes. You can learn more about our structure, download the investor kit. Of course, you can reach out to Eric and I directly, no problem at all. Our emails will also be in the show notes, so that'll help you. But again, we'll just give you the link. But this is a great opportunity for our investors to add a complement to their portfolio, which is cash generating in the fast growing segment that has shown us some resiliency across multiple business cycles, right? So our operating team, very experienced team, as I mentioned, operations focused people. We've got 2+ decades of experience working for top brands like Wingstop and Taco Bell.
Okay, thank you. Well, let's move on to our last section. So we're going to wrap things up now. We're coming towards, sadly, summer's ending, and we're coming.
And it's not sadly. I'm very happy summer's ended because you don't live in Dallas, man. It was like 1 billion degrees in Dallas this entire summer.
Yeah, that's true. That it was quite unbearable, but it's okay up here. So 2023 is coming to an end soon. What are we seeing in terms of opportunities, high level wise? Omar, can you give us some upcoming deal previews?
Look, as I mentioned, we're looking at acquisitions, but those opportunities, I believe, are going to be more prevalent, and juicier opportunities are probably going to happen in 2024. I can tell you that we will have absolutely one more development, which is coming up, the Maple Rock Reserve in Sioux Falls before year end. It's a great development again. Same principles and concepts as our other developments, high 7s, I think a slightly above 8 return on cost. And again, the reason is very simple. These are no-brainers. We invest in our own projects. We sign on the recourse debt, which means if things go sideways, there is a personal guarantee we're attaching. So there's a big alignment of interest there between sponsors like ourselves, our investors. And again, that's a credit to my partners, Dustin and Caleb. But I just want to say that the reason why I'm in partnership with these people is always because they also take on liability on their shoulders. And I live in Dallas. I get a lot of people reaching out saying, hey, we should develop, we should acquire, we should do this. And when it comes time to taking money, everybody has their hand out. But anytime you say, okay, why don't you sign on the loan and take some personal guarantee and put your personal guarantee on the line, right? Everybody shies away. I always like to have interests aligned. I always like to make sure that we're all rowing in the same boat, same direction. And I believe Sioux Falls is absolutely ripe for development. We picked the right market. It has a lot of demand, not enough supply, but it won't be like this forever because, again, like I mentioned, it's on the institutional lens now. More and more of that capital is coming. And that's just the reality of the situation, right? I get a few calls a month from institutional folks. This is going to keep, this trend has continued systematically for the last year and a half. And of course, for diversification and cash flow, we've got our QSR cash flow fund. Happy to talk more details about that.
Okay, and let's not forget about the multifamily investment event that we hosted in Las Vegas. There were, I think, almost 250 people. We absolutely crushed it. A lot of things happened, and we had a short timeline, but we crushed it. And I'm super grateful for everyone who attended, our sponsors, the Ignition event management team. Omar, do you want to give a brief summary about that event?
Look, it was a fantastic event, and I'm really grateful for everyone who participated. In particular, I'd like to thank our headline sponsors, Pine & Co. Great CPAs. You should totally hire them. We get all of our accounting work from them. I've referred tons and tons of people to them. And Walker & Dunlop, Mark Winitsky at Walker & Dunlop. He's your go-to guy for all capital markets, loans, whatever you need. He's the guy. You got to go to these guys. We're very grateful to them. And lastly, I'm very grateful to Jonathan Twombly. He's my partner who's a co-organizer with me from Two Bridges Asset Management. Look, this event was called the Multifamily Wealth Project. It covered the gamut of multifamily investing from acquisitions, developments, distressed properties, capital markets, lending. And our panel had people from all of these facets, right? So we wanted to make things work for everyone. We wanted to make the right introductions to the people that we feel really strongly about. And by the way, these are other operators, right? These aren't just, say, investors. We introduced our investors to other thoughtful operators that we felt, even though somebody might say they're competition, but we feel like we admire them, right? We feel like they're doing the right job. So we always want our investors to be sophisticated, to see what else there, because the more investors get sophisticated, the better it is. And lastly, I'd like to take this opportunity to give a shout out to Eric. Eric, thank you so much. This would not have been possible without you, frankly. I mean, I'd be a duck out of water. And you took on a lot of the stress. You took on a lot of the stuff that I downloaded, or as I like to say, delegate to elevate on you.
Thanks. Yeah, I really felt elevated. Yeah.
Yeah, and without you, this would not have happened. So thank you so much.
And you know what? It was an awesome opportunity to meet some of our investors, our partners, chatting with them on the phone. And by the way, I always like to chat with our investors. So give me a call if you if you have any questions or if you need anything. And really, I think it puts everybody on the same side of the aisle just to position ourselves for success together in the upcoming years. And we do plan on doing more of these events in the future. So I think that wraps everything up. And thank you for watching. If you have any questions whatsoever about what we talked about today, or just any other questions, you can email me at eric@boardwalkwealth.com. So if you want to talk about the deals, any fund info, or if you just have any questions about data analysis or what's going on with Omar and myself, feel free to reach out. You can call me, email me. Thank you so much.
Thank you, everyone. As always, we appreciate your time, but most importantly, I personally appreciate your trust. Thank you.